Welcome, traders. We spend most of our time learning about charts, patterns, and strategies. But there's an invisible force that often determines our success or failure more than any indicator: our own mind. Today, we're diving into one of the most critical yet overlooked aspects of trading: mindset and bias awareness. Let's set the stage. Trading is not just a technical challenge, it's a mental game. A disciplined mindset, combined with a sharp awareness of our own cognitive biases, is what separates consistent traders from the rest. The purpose of this lesson is simple but powerful: to help you identify and overcome the common psychological pitfalls that sabotage profitability. Why is mindset so important? Because trading is fundamentally probabilistic, not certain. You will have losses. You will be wrong. The key is how you respond. The qualities of a successful trading mindset aren't about being a genius, they're about character, patience to wait for your setup, discipline to follow your plan, emotional regulation to keep fear and greed in check, and resilience to bounce back from a losing streak. This is the foundation everything else is built upon. So, what are the enemies we face? These are the common mindset pitfalls that trap nearly every trader at some point. FOMO, fear of missing out, chasing a trade that's already moved, driven by the panic of not being in. Overconfidence after a few wins, leading you to take oversized risks. Revenge trading, jumping back in right after a loss to get your money back, a guaranteed path to a blown account. Impatience and the desire for quick results, which causes you to force trades. And emotional attachment to a trade, where you refuse to close a loser because you believe it has to turn around. Look at this chart. It's not a price chart, it's an emotion chart. This is the real market you need to learn to navigate. These pitfalls are often fueled by deeper, hardwired mental shortcuts known as cognitive biases. These are systematic errors in thinking that affect our judgment and decisions. In trading, unchecked biases lead directly to poor risk management, overtrading, and ignoring the clear signals of market structure because they don't fit our narrative. Let's put names to these invisible adversaries. You need to be able to spot them in real time. Confirmation bias: you actively seek out information that supports your existing opinion and ignore everything that contradicts it. Recency bias: you give too much weight to what just happened. A few wins make you feel invincible, a few losses make you feel like you'll never win again. Loss aversion: the pain of a loss is psychologically twice as powerful as the pleasure of a win. This leads to closing winners too early and holding losers too long. Anchoring: you get fixated on a specific price, like your entry point, and it clouds your judgment for where price is actually going. Herd mentality: following the crowd into a crowded trade instead of sticking to your own validated strategy. Knowing these is your first line of defense. So, how do we build a stronger mindset? It requires deliberate practice. Your number one tool is a well-defined trading plan with strict, unbreakable risk management rules. This is your anchor in a storm of emotion. Maintain a trading journal focused on your psychology. Why did you really take that trade? Review your mistakes with curiosity, not self-judgment. Analyze them like a scientist. And practice mindfulness. Just a few minutes a day can improve your emotional regulation and self-awareness at the charts. Alongside mindset, we need practical techniques for bias awareness. Pause and breathe. Before you hit buy or sell, take a moment. Ask yourself, am I calm or am I acting on FOMO or fear? Use objective criteria. Base your decisions solely on your predefined rules: support/resistance, liquidity zones, order blocks. Not on a gut feeling. Backtest and review systematically. Data doesn't lie. Your backtest results are a powerful antidote to the stories your biases tell you. Find a mentor or trading peer. A second pair of eyes can instantly spot the biases you are blind to. This is especially critical in smart money concepts. SMC is all about reading the subtle clues of institutional behavior, liquidity pools, order blocks, and true market structure. Your biases will cause you to misread a simple pullback as a reversal. See an order block where there isn't one because you're anchored to a past trade. Or jump into a liquidity grab because of herd mentality. Maintaining discipline is what ensures you adhere to the objective rules of SMC, not the subjective whispers of your biases. Knowledge without action is useless. Here is your action plan. Daily, do a quick mindset check-in before you start trading. Set your intention. Weekly, in your journal review, categorize your trades. How many were driven by a pitfall or bias? Monthly, pick one bias to work on. For 1 month, make it your mission to spot and neutralize it. To conclude, remember these key truths. Mindset and bias awareness are not optional, they are the bedrock of consistent performance. Emotional regulation plus discipline leads to better execution, which leads to better results. Continuous self-reflection isn't just therapeutic, it directly enhances your profitability and your confidence. Master your mind, and the markets will follow. Thank you for watching.